The differences between two popular exchange-traded funds, ETFs, are worth exploring. The main distinction lies in their underlying indices. One is managed passively in reference to the S&P 500 index, while the other tracks the performance of the Nasdaq 100 index. Both indices are widely followed benchmarks in the U.S. equity markets, but they have significant differences, such as weightage, which affects their adaptability. As a result, these ETFs align with the performances of their respective indices, exposing investors to varied adaptability and performance. In terms of investment return-based performance, the two ETFs have relatively close returns since the beginning of the year, with one presenting a 6.85% return rate and the other a 6.66% return rate. However, if the return period is extended to a decade, the Nasdaq 100 indexed ETF outperforms the S&P 500 indexed ETF, with an average annual return rate of 18.14%, which is 5.47% more than the latter. Another distinguishing factor is the dividend yield rate, with the S&P 500 indexed ETF currently offering an annual dividend yield of 1.31%, significantly higher than the 0.73% offered by the Nasdaq 100 indexed ETF. Despite their differences, both ETFs share some similarities, including being dividend ETFs that offer investors an annual percentage of their shares as dividends and adopting widely acknowledged indices in the U.S. equity markets. Ultimately, the choice between the two depends on individual investment preferences, but the S&P 500 indexed ETF may be a better option due to its high dividend yields and short-term return-based performance.